This is a podcast produced for EIS Platforms Limited, trading as growthInvest. It is not intended to be a financial promotion of any sort and is intended for financial professionals only. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high-risk investments, and you are unlikely to be protected if something goes wrong. Don't invest unless you're prepared to lose all your money. Hello, and welcome to the Alternative Thinking Podcast with Steve Dobson and Melissa Griffiths. This is the podcast that takes a deeper dive into the alternative marketplace and explores topical issues. Today, we're joined by Richard Penny of Oberon Investments to talk about the UK small cap market. Lovely to have you, Richard.
Thank you for inviting me.
Now, we normally like to start with a bit of a sort of background on your career to date and where you are now. So could you give us a bit of a...
Yeah, so I've been a UK investor for 33 years. Actually, before that, I started investing in privatisation issues with my own money. That's nearly 40 years ago, TSB, British Gas. I started up in Scotland. I worked for a life insurance company. I moved to M&G. I was on the recovery side, and we see elements of that in a lot of what I do now. Yeah. But I also ran a technology fund there in 2000, which was good and bad.
Yeah.
And then since then, I've worked at Legal & General for 15 years, mainstream, where I invest in long-term growth companies, usually when they have difficult periods, so contrarian growth investor, but concentrated stock picking.
Mm-hmm. Yep.
And then more recently, I've gone boutique, so where we sort of invest our own money, invite anybody that wants to come into our funds and invest on the same terms. And we look for companies where, well, we'll talk about that in a minute, but, hand-selected, boutique style, a satellite style versus, more institutional, mainstream or index investing.
Yeah, and so your fund at Oberon, then, can you explain a little bit more on what the fund is and what exactly?
Yeah, the central thesis, contrarian investing of growth companies multi-cap, is our UK TM Oberon UK Special Situations Fund. 25% in large caps, some mids and some smaller caps.
Yep.
And then we have a specific, more aggressive version of that, which is purely small, a micro cap. If you like, it's higher risk, but it's higher opportunity.
Yeah.
We think starting from here, you might make better money. Mm-hmm. And then we have Special Sits Light. This process that's outperformed over 20 years is a business called the Core TM Oberon Core.
Right.
Where we have more of a 3 to 4% income on that product. We've got more large companies and less of these small cap companies.
So slightly less risky.
Yeah.
And these are all listed companies, aren't they? Just contrary to what we kind of talk about a lot in the
all of the investments are listed UK businesses, listed on UK stock exchange.
And so you're generally looking, you have a tiny, well, not tiny, but sort of 25% exposure in large cap, and then it is the mid, small cap and micro cap.
It is, yeah.
And obviously with the UK at the moment, we've had some economists on, Callum and Simon, who have been talking about the UK being very undervalued. Is that something that you're beginning to sort of really focus on as well now in terms of, and they're saying, it's really coming into play as you get more and more down the cap.
Yeah, so we have actually been saying that for 3 or 4 years. Okay. And up to a year ago, everybody'd say, well, you've been saying that for 2 years.
Yeah.
And it's become more and more increasingly out of kilter with the US, which some people think is a great collection of businesses, but overpriced. We'd agree with that. The UK, the large cap, the whole of the UK market, yields 3.6, 3.7. It doesn't necessarily compete with cash on the headline dividend, but the buybacks and the takeovers we see in the quantum money there would take you up towards a 6 to 7% yield, which does compete with cash.
Yeah.
And then if we go down into mid and small cap, the thing that's been happening for the last 2 or 3 years as pension funds, life insurance companies, savings people have been moving to global benchmarks. Money has been flooding out of the UK and going into the US.
Yeah.
It's depressed UK valuations, which is an opportunity to your point, and maybe made the US more expensive. What we've seen in the last quarter, Q2 of this year, is starting to see people move or question the amount of money they've got in the US post-Trump.
Yes.
And we've started to see people go for alternatives. And the UK is, for all that people have some issues with the UK economy and the UK political system, that's been priced in.
Yes.
The UK's been a difficult market in many ways for 10 years, but particularly since September 2021.
An interesting say that, because you've been in the market for a long time, the history you gave in terms of your career-wise. Can we go back a little bit and talk about that UK market? And because it's not been an easy environment to kind of invest into, and obviously stock picking different from tracking benchmark indices. But just talk about how the UK market has performed, and particularly over the last 4 or 5 years prior to what we're seeing today.
Yeah. So if we go back 10 years, post the Brexit vote was around 10 years ago.
Yeah.
We've seen, if you segment the UK market into international stocks and domestic stocks, you've seen the international stocks outperform by 40% over 10 years.
Yeah.
Over 10 years, it might not sound so much, but basically what happens when people underperform, because they've got domestic stocks, which would tend to be mid and smaller companies, the people that give them money take it away from them and put it into the growth investments. So that's a fairly nasty headwind. Specifically since September 2021, when interest rates started to go up, that again was quite negative. But I think, with Donald Trump and the implications for US investing for the long term over 4 or 5 year periods, the uncertainty around that, and also for the dollar, people, as we've said, are then questioning that. So Donald Trump, starting in Q2 2025, this may well be a turning point for markets. And
it's a bit of a rotational asset.
Yeah, we're seeing that, and people are commenting on that. I think from our point of view, we see the UK as cheap. In a sense, because we invest in the UK, it's not our job to say the UK is going to beat the US.
I was just going to touch back on, obviously you looked at, we'll work through the TMT. In terms of sort of stock selection, and obviously there's a big emphasis now on AI, life sciences. Some of these are a bit more potential bubble-like. Is that something that you're conscious of in your portfolio selection?
We are, but the interesting contrast at the minute is, if we look at the US, if we look at sentiment and investor behavior, which I use a lot in how I invest. In the US, people are very credible of anything in future, and they look at Nvidia, which may well be a brilliant business. It may well prove to be great, but at $4 trillion, it's hardly a hidden secret.
No.
If we look at UK companies, just because of the outflows and the amount of investors selling that we've seen, there's very, very little featured into anything for future prospects. In fact, you could say we have had a downturn in the UK. Prospects have come down a bit, but valuations are low and investor participation rates are very low. And actually, when it's most interesting is when you have the potential for those three to recover from low levels.
Yeah, yeah.
And then with I guess you touched on it, the globalization piece, and US becoming a lot more volatile post-Trump, and people are focusing back on the UK now, and we seem to have a fairly stable environment, economy going on, and the small cap, mid cap are going to benefit more from that kind of domestic feeling sentiment around the UK. Yeah,
so we mentioned sterling, dollar, and the dollar's been weaker since Trump. That prior to that, the dollar was very strong, and the place where everybody went to. That's why the international stocks did better. Those UK international stocks were a proxy for investing in the US, if you like, and the US, of course, did better than those. The domestic stocks did less well. With rates going down, that tends to be a huge kicker for mid and small caps. And to contextualize that for anybody that doesn't know this, small caps do tend to outperform. The bottom 10% by market capitalization since 1955 have outperformed. In developed markets, actually, by 2.5% per annum. If you go into the bottom 2%, where there's sort of micro caps, they've outperformed by 4%, but they're very cyclical, and so they tend to underperform on the way down. We've certainly seen that in the UK, often driven by outflows and liquidity, which has been pronounced in the last 3 years. But when rates go down or the economy picks up, often rates going down does lead to some sort of economic pickup. Then they outperform hugely, and we've historically benefited from that. So the AIM market relative to the FTSE the sell-off has been twice as bad as what happened in the GFC 2009. And this is when people were queuing around the block to get their money out of Northern Rock. There's been difficulties, but this has not been as difficult in an economy, and yet the market sold off worse. For me, that's been the opportunity that set up these triple-digit returns.
Yes. Yeah. And actually moving on to AIM, it is under pressure. We've seen, I think you've got interesting statistics on, how much is coming out of AIM in terms of companies. Now there's hardly, I think they were down to 600 or so, is that right?
Yeah, it would have been 1,500 sort of 5 or 10 years ago. It's at 600 now. It's a problem for the market environment, but actually, takeovers create performance. It does demonstrate there is some validity in what we're saying. If people are doing due diligence, be they private equity or US corporates come in and buy British businesses, then they do demonstrate that the value's there.
Yeah.
And that's what happens. So you do not need huge flows of money into UK markets from wealth or pensions. You can get these takeovers that are a positive.
Yeah. So there's a lot that's happening in terms of trying to encourage investment into the UK and into the likes of the small cap and mid cap. Is there anything that you think they could do? We've got the LSE coming on in a few weeks for AIM. Is there sort of regulatory...
Don't hold back.
Don't hold back. Well, let's be constructive. I mean, the pensions market, we have seen UK equity weightings go down from 30% 20 to 30 years ago down to sort of 2 to 4%. And since, in the last 5 or 6 years, they've gone down from mid digits. So actually that outflow has it does depress prices, and that's why the UK is at the discount. That is the predominant feature. And I think the regulatory environment, it's to do with how people perceive risk. So, if you invest in equities, there's a 12 to 13% chance historically that you lose money over the next year. If you invest for the long term, it gets to be really low. So 5 or 10 years, it's down to 1% chance of losing money. We're starting from a low valuation. But unfortunately, the regulator is focused on the chance, that risk that you might lose money on 1 year. But, one of the free lunches in investment is that you invest in equities if you're investing over any moderate period of time. Even for people at 50, 60, 70, with people even to live into 80 and 90, they should have money in equities.
Yeah.
And, if we're talking long term again, then, long term returns are a function of what your starting valuation is. And the UK is a lot cheaper than the US, irrespective of how you feel about US tech stocks. The market is aware that they are great businesses.
Yeah.
And it is discounted. And there's, perhaps a lot of the future discounted in those prices. So in terms of what the government could do, they could make sure that UK equities are put in a default for workplace pensions.
Yeah.
When they aggregate the local government pension schemes, they could make sure that more of that money goes into the UK. For some people, that is an issue because you're mandating it's a non-market solution, and it's not free markets. Most of us probably believe in free markets, but the Australians and the
I was going to say it does happen
happens.
in
around
Australia
the world.
and New Zealand, they're up at 40% in domestic equities, and their weighting in the global benchmarks is sort of 2. In the US, they're 10% over. I think they're sort of up towards 80% in domestic equities. So the pension funds should have the freedoms, but if they want the tax breaks, should the Treasury then demand that some of that goes into UK assets? And I would argue it should definitely go first into lower risk quoted equities, because even if you do that, it will draw funds out of the venture system. Yeah, there is a danger that they go straight to venture, but that's which is private assets, but they are earlier and higher risk.
Yeah.
But isn't that what they're saying as well, though, to put some of the pension money into the private markets and particularly into the UK, which is a little bit contrary there to, what we're saying about, going into the more liquid and stable, theoretically more stable companies?
Yeah, so they're talking about private assets. That includes infrastructure assets.
Yep.
So that would be when the government has less flexibility, frankly, to invest in infrastructure projects, that they would then move them onto the balance sheets of insurance companies and pension funds. And that could work for both parties, obviously.
Yes.
But then when you're moving into venture, that's a different thing. Although they're all private, they're not stable revenue-producing assets. They're early-stage businesses, often 1 or 2 years in.
Yeah.
We have a lot of UK companies that are development capital. They know the businesses work. They're 10 or 15 years in. they're actually not employing people because they can't access capital. We have a market failure in the AIM market at the minute. It's an opportunity for investors. But if the government were to sort of put more fuel in the tank and allow people to do a bit more of investing, then we would definitely create jobs in the kind of scale up as opposed to the startup in the UK.
Mm-hmm.
Yeah, yeah. And just something we touched on earlier, which I was interested in, was we were looking at the sort of the change in the UK in buybacks. You came out with an interesting figure with the FTSE 100.
Yeah.
I think it was 61 buybacks.
Yeah, so earlier this month I looked at, on June the 30th, I think it was the end of Q2, 61 of the FTSE 100 companies, the largest companies in the UK, have bought back shares this year. And that's important because everybody focuses on perhaps the money that's been going out of the savings market.
Yes.
So roughly last year, 10 billion went out of UK equities on sort of savings ISA type open-ended products as opposed to pensions. So that was 10 billion out. But the buybacks last year was about 55 billion. It is biased towards banks and Shell and BP. But obviously there's 61 other companies doing it. And actually, you know, if the buyback level is 55 billion in addition to a dividend of 85 billion, then the 10 billion of outflows is less of a problem. And what we saw in June is the rate of outflows is down to about 5 billion.
Yep.
So in addition to that, you have M&A, which for the first 6 months of this year was about
Picking up, isn't it?
25 billion pounds.
Yeah.
Most recently, things like Spectris is about 4. And you would probably expect that to continue at that sort of rate for the rest of the year. So if you take the 85 billion of dividends in the UK, that's about a 3.5% yield. The buybacks and the M&A would be about another 3.5%. So it would take you to almost a 7% yield.
Yeah.
With the buybacks, you don't get it in your pocket, but you do get increased participation in the future cash flows of businesses.
Yeah.
The free floats.
Yeah. So. And that sort of, if you reduce the supply, then actually the shares will go up, and we've seen that as at stock level. So a low growth business such as Imperial Brands, 2 years ago, 10% yield, starting to do buybacks. First year it didn't have an effect. Second year, the sellers seemed to disappear, decided they like the 10% yield. Shares are up close to 100%. I think they're up about 80%.
So do you think this is going to be a new thing coming into the markets for the next few years?
Oh, it's certainly worked for us in our large cap investing. If you target the companies with the big buybacks, if the prices stay as low as they have been and are, even in large cap, at some point you buy back all the shares and the last share owns the whole of the cash flow, which inevitably that's not going to happen.
Yes.
And
so it is creating a bit of a squeeze.
Yeah, and in the same way that sort of happened with Imperial Brands, probably retiring 10, 15% of their equity, you're sort of seeing that happening in the UK market. So, 2-3% of the whole supply of equity disappearing. At some point the prices go up and we will get new IPOs, which we do need for the long term.
Yes.
But yeah, it's not all doom and despair.
No.
I guess over your career then, where do you see the opportunity in the UK now relative to past cycles we've seen?
Yeah, to be very clear, the once in every 10-year opportunity we have at the minute in small cap is the best one we've had in 30 years.
So you're calling it a once in a 10 year?
Yeah, it is, because it's twice as bad as the GFC.
Yeah.
I would think if you had similar people to me, those of us that are left, they would say, things are just the wrong price.
Yeah.
And this is why these private...
And the wrong price meaning they're undervalued.
Yeah, so if I say it's a difficult market, I don't mean companies are trading worse. They are trading worse. I mean, they're trading way below what we think the right value for them is. You could almost argue that's a market failure in that the companies can't access capital at the right price. You want things to be efficiently priced, unless, of course, you're an active manager and you're putting your own money in it, in which case you want things to be really cheap.
Exactly.
The problem is, whenever I've seen things that have been really cheap on a 10-year basis, you've just had a difficult 2 or 3 years, because that small cap effect, it sort of kicks you in the midriff a little bit. It's sort of, you have a downturn as the rates go up, and then you look at your worst just as it's about to become better. And we do, for the last, we've had a reasonable 7 months, but the last 3 months post-Trump has been quite positive. We've seen some sort of moves in some of the AIM shares, and the market will repair itself one stock at a time. People, a seller that's been out there for 2 or 3 years will finish selling, and then suddenly there might not be any stock available and the shares might pop 30 or 40%. And our experience is that over an 18-month to 24-month period, some of the stocks go up 2, 3, 4, 500%.
Yeah.
And some of it is from incredibly low share prices when we refinance businesses.
Yeah.
They can be refinanced at £1 or £2 million, total distress because they're running out of money.
Yeah.
Often a business that might have had £100 million put into it. It might have intangible assets that are incredibly interesting. It's a downturn, sales cycles, are slower. You might well get your hands on something, at 1 or 2 pence in the pound, and those can be career makers for people.
Yeah.
Something I'm interested in, it's obviously there's IHT new legislation coming in around the pensions and AIM as well. And do you feel that with the AIM market, it is going to have an impact? We see some wealth managers moving away from AIM IHT products towards the asset-backed. We've also got VCTs, which are AIM-orientated. Do you think there's going to be a sort of... Because although you're talking about a positive upside, there is this hanging in the wings as well, coming in 2027, I think.
So the bigger AIM stocks, the IHT type stocks, quite a few of them, about 4.4 billion, have moved up to the higher, the larger market. And there has been a positive effect in the top end of the AIM market, above £200 million market values, which is only 10% of the AIM market actually, by number. There has been a positive effect at some of those monies as they move up into the full list, as opposed to AIM, gets reinvested back into these other companies.
Right.
But that IHT participation has been in the bigger, more stable businesses. The huge opportunities are often in the companies under 50 million. And to put that in context, on the AIM market, there's, I think, 45% of it is under 20 million.
Right.
Wow.
And at this point we say concentrated stock picking, there's only certain of those that we're interested in. But some of these businesses at 20 and 50 million market values have got 200 million of revenues. They used to make 15 or 20 million. They maybe break even because it's been a difficult economy.
Yes.
But you buy them when the market's difficult and you can make multiples of your money on the way up. You won't get them all right.
No.
but these are the factors that create this outperformance from small and micro caps through the cycle.
So you still feel that there's going to be a strong AIM market going forward, and we might even see more companies coming back into AIM because we've got Pisces as well coming in?
I think that trading will pick up. Trading has been depressed in the individual constituent companies, but the major opportunities in this valuation from this sell-off. The sell-off has been unprecedented because of constant outflows on AIM, and this is why we're seeing companies getting taken over. When the receipts from takeovers come back to us, we'll buy some of the stuff that continues to be the wrong price. We've got far many more opportunities than we have money at the minute.
Really?
But definitely. And, it's a paradox that I mentioned it before, that the best opportunities are after you've had the worst 2 or 3 years, because it's a V-shaped recovery. So, of course, you look bad. And this downturn in small caps has been 3.5 years. It's normally a couple of years.
Right.
So normally everybody looks at 3-year track records, and there's at least one good year in there. We've got 3.5 bad years there, but we have seen a reasonable recovery. As I say, over 6 months, we've probably seen the worst of it. And this small cap investing is something that I do. It's a game that we can win. We win at doing this over the long cycle, but you have to ride out the cycle. And arguably, if it's a winning strategy, if you've got 3.5 bad years out the way, it's a pretty good time to get involved.
To be reinvesting. Yeah.
I mean, I guess we also need a bit of a sort of more stable geopolitical climate as well. I mean, is that something that's kind of... I mean, we've had a lot going on, war with Ukraine, then we've had recent...
Yeah, I mean, people do de-risk, but people are invested in equities. And I think we've touched on it, but the US seemed to be a sure bet for so long. And despite the fact that the US was going up, so people ended up with more and more of it in their portfolios, they kept putting more money into it and taking it out of the UK.
Yes.
I mean, there's certainly the insurance companies in the UK, the life insurance companies have sort of suddenly said that they're, one of the very big ones, I think, was just saying that they were going to move from... reduce their UK weighting. Seems like exactly the wrong time. But usually when large insurance companies do things like that, it's a sure sign you should be doing the opposite.
That's another
In a
tip.
way, Trump's been very helpful for the UK
I was
market.
going to say, yes.
It's
Well,
the
definitely has.
volatility he's created there,
Yeah.
and a fairly stable economy here now. It feels that it's and valuation's so low, the opportunity set feels right.
Yeah, the UK is, for all that we can be negative about politics, I mean, the UK stock market isn't the UK economy, and the valuation is discounting quite a lot of bad news. There are some higher valued international companies up at 20 and 30 times in the UK, but there's a lot of stocks yielding 5 and 6, and with PEs of 7 and 8, trading below book value in the large cap environment, doing these buybacks. They're interesting, and then you've got a bunch of mid caps. The UK's got more stocks that have gone up 30 times per 100 stocks. It's got the same or a few more than the US.
Wow,
So there have been some big winners, and the starting point for those has historically been in a downturn, when everybody's sort of switched off and sold them down to very attractive levels.
Well, I mean, I think that sort of...
Well, I was just going to tie it back
One
in,
more?
just thinking about the tax-efficient market, which we've not really touched on here, just obviously because of your background and what you're doing, but it kind of flows through because we've seen this in the tax-efficient space, EIS particularly, the lack of exits, which has been, a detrimental factor, new investment going into EIS. But what we are seeing this year are exits happening, be it through IPOs, more so through either trade sales or M&A activity. But this really ties into what you're saying about this positivity around the UK economy. That is going to filter through to the venture space too, because the opportunities will increase for those to grow. Yeah,
and specifically in the VCT space, it will be smaller companies, either quoted or unquoted. We outlined that 90% of the AIM market is under 200 million, and some 45% I think is under 20 million. If we see any kind of recovery, and we started to see a bit of speculative interest in some stuff where we don't invest in sort of blockchain treasury, these kind of things. That's sort of quite positive because it spills over into other stocks, and then the increase can be quite significant. When people start making money, they can, there's buyers for stocks that they want to sell, they can reinvest it. IPOs become more possible. An IPO is usually an exit for a private business, and it frees up capital. So that could happen anyway. So if the government would like to help with any sort of loosening of regulation as well, that would be incrementally positive.
Well, I mean, I think it sounds exciting. So as far as you're concerned, the right place to be is small caps, mid caps.
I will always say I will always say that, but actually, to frame it, and I think I've done it a couple of times, the sell-off has been twice as bad as the GFC. The economy is nothing like as bad. That's the top-down vision. On a stock-picking basis, we can see loads of things that just seem like they're the wrong price. We won't get them all right, but we should make really good returns from those, looking out 3 years from here. It's been difficult economic, but nowhere near as bad as GFC, and valuations are very low in small and micro-cap.
Well, it's been lovely having you, Richard. And we hope to get you back on, maybe, see how you're performing then.
Thank you. Hopefully in 3 years' time, everything will have doubled.
You'll be able to reflect back on this and
Perfect.
tell us it worked exactly right.
Yes.
Thanks very much for joining us.
No, that's great.
Thank you.
Thanks.
To hear more, tune in to either YouTube on video or all good podcast channels.